California's housing market is no longer moving in one direction. Instead, it is splitting in two, one housing story along the coast and a completely different one inland. If you live in or around California, this split is already shaping your options as a renter, buyer, seller, or even an investor. And 2026 is the year it really starts to matter. Right now, coastal cities are still starring in the expensive, stubbornly high-priced story, while inland California is quietly becoming the place where more people can actually afford to live, or at least get closer to owning a home. Today, we'll walk through what's really driving this split, what it means for you, and which side of California is likely to win, or lose, over the next few years. The big idea today isn't just that California is expensive. The key trend is that the coast and the inland are reacting differently to the same pressures: interest rates, job growth, remote work, and migration. Along the coast, from places like Los Angeles, Orange County, San Diego, and the Bay Area, homes still command big price tags because supply is tight and demand is strong from higher-income buyers. But inland, in places like the Inland Empire, parts of the Central Valley, and some outer suburban counties, prices are lower, rents are more manageable, and more people are willing to trade a longer commute for a lower payment. So instead of one California housing market, what we really have is two: a coastal market that's more about price, prestige, and in-person work; an inland market that's more about affordability, size, and flexibility. Understanding that split is what will help you make smarter decisions in 2026, whether you're renting, buying, selling, or investing. Before we jump into cities, let's ground this in data. Statewide, California's 2026 forecast still points to modest growth, not a boom. The California Association of Realtors and several housing outlooks put the statewide median home price around $905,000 for 2026, which is slightly higher than the past couple of years, but nowhere near the wild growth we saw a few years back. At the same time, the cost of owning a home in California remains far above the cost of renting in many areas. That gap is what keeps pushing people toward renting and keeps the inland equals cheaper story alive. Interest rates are still above the rock-bottom levels of the early 2020s, which means every extra dollar in price or mortgage matters more than it did a few years ago. Let's drop into Southern California first, because it's where the inland coast split is the most visible. Start with Orange County. Along the coast, including places like Newport Beach, Laguna Beach, and coastal Irvine, you're looking at some of the most expensive real estate in the entire state. These markets are still very price-sensitive but remain premium because of location, schools, and quality of life. Inland Orange County, including cities like Anaheim, Santa Ana, and parts of Orange, is more mixed. It's still pricey compared to the Inland Empire, but it's significantly cheaper than the beachfront or near-beach neighborhoods. Now move east to the Inland Empire, Riverside, and San Bernardino counties. These areas have long been the escape valve for people priced out of LA, San Diego, and even parts of Orange County. In 2026, that pattern continues. Because prices there are still well below the coastal counties, more first-time buyers, move-up buyers, and investors are showing up. The downside is that commutes can be longer, and traffic is very real, but the trade-off is often a much lower monthly payment. If you go further east into the desert, like Palm Springs and the Coachella Valley, you see a different story again. Some of these markets are still hot for vacation-style buyers and investors, but they're also more seasonal and sensitive to loan rates. That makes them more volatile than the core inland markets, but still clearly part of the not the coast side of California's housing split. Now flip over to Northern California. The Bay Area is a great example of how the coast and inland are telling different stories. In San Francisco and parts of the core Bay Area, AI-related job growth and tech hiring are helping to keep demand strong, especially at the higher end of the market. AI is not just a buzzword here. It's a real job driver that's supporting home prices and even helping office markets recover. That means coastal and core Bay Area neighborhoods are still very expensive, and they're still attractive to high-income buyers. But move just a bit inland, into parts of the East Bay, or out toward the Sacramento area and the Central Valley, and you see a different picture. These areas are more affordable, easier to finance, and increasingly attractive to people who still want to be within driving distance of the Bay Area but can't afford to live there. That's why cities like Fresno, Sacramento, and even parts of the Central Valley keep showing up in conversations about where California buyers are going next. So in Northern California, the split is between the AI, tech-fueled coast and core, where prices stay high because of high income demand, the inland and outer suburban commuter belt, where buyers are trading some proximity for a lower price and more breathing room. So why is California effectively splitting into two housing markets? There are three main forces at work. First, prices are still too high near the coast. Even though growth has slowed, coastal homes remain expensive enough to push out large segments of the population. First-time buyers, middle-income families, and even many renters are priced out, which forces them to look farther out. Second, new supply is limited in the most desirable coastal areas. It's hard to build new homes in places like San Diego, coastal Orange County, or San Francisco. That means scarcity drives up price and keeps competition intense, while inland areas still have more room to grow. Third, people are more willing to live farther out. The pandemic, remote work, and hybrid work schedules rewired how people think about commutes. Even though more people are going back to the office at least part-time, the trade-off of a longer drive for a much lower housing payment is still attractive to many. That's what's pulling demand inland, especially in markets where the payment gap is wide. It's not just AI or returning to the office. It's a mix of all of these factors that's making coastal California feel like a luxury and inland California feel like a practical choice. Now let's talk about what this split actually means for renters, buyers, sellers, and investors in 2026. If you live inland, rent growth may stay strong because more people are moving there and demand is rising. That can mean higher rents over time, but it also means landlords there have more people to choose from. If you live on the coast, rents are already high and the fight for housing stays intense. Moving inland might save you money month to month, but could mean a longer commute. If your goal is ownership, the inland side is where you're most likely to get a realistic shot in 2026. Even if you have to drive a bit, the price per square foot is usually better, and you're more likely to find a home that fits your budget. On the coast, buying is still possible, but your options are narrower, and the competition is fiercer. You still have a lot of demand, especially if you're in a high-quality area with good schools and amenities. But buyer pools are tighter now that rates are higher. That means you may have to price a bit more carefully, wait longer for the right offer, or be flexible on terms. Inland markets can be more price-sensitive, but they're also where more people are actively looking. That can speed up sales, but it can also mean you're competing with more listings as more builders and investors move into those areas. From a numbers perspective, many of the best deals are still inland. Lower home prices plus solid rents can create better cash flow than the coast, even if you're operating at a lower absolute rent level. We should expect this split to get sharper, not softer. The coast will likely stay expensive and supply limited, with pockets of strength in tech-driven areas and wealthier neighborhoods. The inland side will continue to attract more people, especially first-time buyers, middle-income families, and investors seeking better math. That doesn't mean the coast is doomed, or the inland is perfect. It just means they're behaving like two different markets. Your strategy should depend on your budget, your tolerance for commutes, and whether you care more about cash flow, stability, or long-term appreciation. If you're young, just starting out, or trying to stretch your income, the inland side is probably where you'll want to focus your search. If you're higher income, more established, or working in a high-paying field, the coast may still make sense, as long as you're comfortable with the price and the competition. California housing is not one story anymore. It's two: the coast and the inland, each with its own rules, risks, and opportunities. If you're watching from either side, this split is already shaping your options more than you might realize. If this breakdown helped you see where you might belong in 2026, hit subscribe so we can keep breaking down these shifts city by city. And in the comments, tell us coast or inland. Which side are you betting on?